everyone, welcome to Investify, where we help you grow your wealth through smart investments. Today, we will be discussing the recent unexpected developments in the housing market. Get ready to uncover the surprising twists and turns in the housing market that will make you question everything you thought you knew. Buckle up because we're about to delve into the jaw-dropping revelations. Picture this. Empty office buildings in San Francisco set to sell at a mid-bowling 80% loss. And that's just the tip of the iceberg. We've got Blackstone, one of the big players in the real estate game, putting a cap on investor withdrawals as panic ensues. It's like trying to squeeze toothpaste back into the tube. Tricky to say the least. But that's not all. Realtor.com has dropped some eye-opening findings on the residential housing market that will make you question the very foundations of home ownership. And just to add a dash of absurdity to the mix, there's a man out there with a fake Boris Johnson driver's license claiming to expire in the year 3000. Talk about futuristic aspirations. So what does all of these chaos mean for the future of real estate? Are we heading towards a housing market meltdown or just a wild roller coaster ride? Join us as we dissect the details and unravel the implications for both commercial and residential properties. Strap in because this is one discussion you won't want to miss. If you're hungry for more tantalizing insights into the housing market and crave investment-related wisdom, make sure to hit the subscribe button and join our ever-growing community. We appreciate your support, and now it's time to dive headfirst into the mind-bending exploration. You know those buzzing office buildings and bustling stores? Well, guess what? They're not owned by the folks using them. Instead, we have a colossal $20 trillion market filled with hedge funds, investors, and real estate investment trusts on a mission to find undervalued commercial properties, give them a makeover, and attract top-notch tenants who'll skyrocket their value. It's like a real estate version of Extreme Makeover. But here's where the plot thickens. These deals involve mind-boggling amounts of money, with groups of investors pooling their funds to make the magic happen. And here's the kicker. Everyday investors like you and me have a shot at joining the game through publicity-traded companies like Simon Property Group and Realty Income Corp. It's our chance to earn passive income from commercial real estate investments. Get ready for the twist. Unlike residential real estate, where you can cozy up with a 30-year fixed mortgage, commercial real estate plays by different rules. Picture this. Fixed loan terms of 3 to 7 years followed by interest rate adjustments. And let's not forget the extra long amortization schedules of 20 to 25 years. It's like a roller coaster ride for your payments. Oh, and watch out for the balloon payment surprise at year 7. If property values plummet, you might end up owing more than the building's worth. The suspense builds as interest rates soar, adding more drama. Picture a wave of commercial properties about to be reset at these rates. Can you sense the tension? It could lead to a property crisis. For instance, CPC reports reveal that 25% of the office building loans will be due in the next year. With interest rates now 5 times higher than a year ago, ownership costs will rise significantly, and this is just the beginning. Commercial real estate valuation depends on 3 key factors. First, it considers the land's potential for development. Second, it evaluates the cost per square foot to replicate the building today. Finally, it assesses the building's income generation. For example, if you buy a building for $1 million and it generates $100,000 in annual income, that's a 10% return. But if it only generates $50,000 per year, the return is 5%. Property owners aim to maximize rental income as it determines the property's value. The more income the property generates, the higher its value. However, these properties are currently experiencing declining rental income and facing tough competition from treasuries. Investors focus on numbers to maximize returns while minimizing risk and effort. When interest rates were at record lows and real estate offered a 4.5% return, it seemed like a good investment. But now, treasuries pay around 5%, basic savings accounts offer 4.5% returns, and most mortgages have interest rates above 7%. This makes real estate less attractive. Why invest in real estate with negative cash flow and a 5% return when risk-free treasuries offer guaranteed returns without any effort? Real estate needs to improve higher returns to remain competitive. Lower rental rates and potential interest rate increases, along with an 18.2% vacancy rate in office spaces, create a commercial real estate crisis. Should we be concerned? Wall Street is showing signs of retreating from the housing market. Blackstone, a real estate investor trust, has limited investor withdrawals due to the illiquidity of real estate assets. Investors requested $4.5 billion from the fund simultaneously, reflecting negative sentiment. Invitation Homes, the largest owner of single-family rental properties, has also scaled back purchases due to the market decline, predicting an 80% crash in San Francisco's office space market. Let's dive into some exciting news that directly impacts you and your finances. Realtor.com's latest housing report. Brace yourself for some interesting insights. According to the report, there's been a whopping 48% increase in active listings compared to last year. While that might sound like a big jump, it's actually just a fraction of what we had before the pandemic hit. What's more, the report reveals that no region saw homeowners stepping up to list their homes for sale in April. It's like people are holding onto their properties possibly to keep their current mortgage rates. Plus, homes spent an average of 49 days on the market in April, which is 17 days longer than the same period last year. But here's the twist. Despite the longer time on the market, homes are actually selling faster this year than they did during the peak years of 2017 to 2019. So we're not seeing the housing crash that some predicted. Now let's talk about the hotspots of price increases and drops. Research from Black Knight shows that cities like Columbus, Ohio, Hartford, Connecticut, and Worcester, Massachusetts have seen significant price hikes, while Austin, Texas, and Provo, Utah experienced sharp declines in just 1 month. And if you look at the overall trend from the peak, places like Austin, San Jose, San Francisco, Seattle, Phoenix, Las Vegas, Boise, Stockton, Sacramento, and Salt Lake City have seen the biggest price drops. Now, how does all this affect you? And more importantly, how can you potentially make money from it? Well, when it comes to funds like Blackstone, investing in real estate carries inherent risks. If you're planning to buy a property, it's crucial to view it as a long-term investment, ideally holding onto it for 5 to 10 years or more. Selling a property takes time, and there's no guarantee of profitability, especially if you don't time the market right. Even if you decide to sell a property you own, it involves listing it, waiting for a buyer, and paying commissions at closing. So make sure to carefully consider all these factors before taking the plunge into real estate. Housing market is serving up some unexpected twists and turns lately. Who would have thought? It's like the real estate market decided to channel its inner drama queen and keep us all on the edge of our seats. But fear not, if there may be challenges and surprises, opportunities still abound. So let's put on our detective hats, grab a cup of coffee or tea if you're feeling fancy, and navigate this roller coaster of a housing market together. Remember, it's not just about finding a house, it's about finding the perfect balance of potential and profit. And if it all else fails, always keep an eye on the trends and adapt our strategies accordingly. The housing market may be unpredictable, but that doesn't mean we can find success and have a few laughs along the way. Stay tuned, keep investing smartly, cheers to unexpected developments and profitable escapades in the ever-surprising world of real estate. I do encourage you to share your thoughts in the comment section, and once again, thank you for your support. That's it for today. Thank you for watching. Don't forget to like this video, subscribe to our channel, and ring that notification bell for more updates here on Investify.